Morning, everybody. We're going to go ahead and get started this morning, and I put up on the screen here, and I'll swivel the camera over here in a second, just to kind of show you where we are. Today, we're going to cover chapter 15, and it's a fairly lengthy chapter, and there's a fairly dense amount of material, so it's probably going to be really consuming of our entire time this week. I do believe that we'll probably get through it before Thursday, though. So we're going to cover. So this is the syllabus here, and so we're into week 12 right here, and gosh, it seems hard to believe we're already week 12. And so we're going to cover chapter 15, which picks up directly from the discussion of chapter 14, which dealt with money and banking. And the reason why we talked so much about banking in chapter 14 is because of the fact that banking is one of the few industries that's got such an integral role to play in the implementation of government policy, and particular monetary policy. And we're going to talk about monetary policy a bit today. And when we come back next week, we'll be talking more about, we're going to get into some discussion of fiscal policy in chapter 17. Chapter 16 deals with more of an international piece. And I'll try to, if I have to cut that out because we are running along with the monetary piece, I will. But I do want to get to the fiscal policy discussion prior to the fourth exam, which is going to be weeks. And so I know it seems like we're coming up fairly quickly, but there's many fewer chapters on this exam, and that really works to your benefit. Remember that we drop the lowest score for exams. So this is an opportunity if you feel like you need to make up some lost ground, that you're really 3 chapters here. And in some ways, I don't think it's the most technical area at all. I think we've sort of passed, even though I've got a graph that I'm going to be putting up probably on Thursday, that looks extremely busy, and I get that, but it's not impossible, and it's not really going to introduce anything that's brand new. So I think in a lot of ways, this is a fairly straightforward area. And so what my plan is to do is to talk about monetary policy, money and monetary policy today and Thursday, and then get into this international piece next week. And I'll probably move into chapter 17 sometime toward the end of next week, so that we can sort of take that Thursday in week 14 to talk about that fourth exam. And then we come back, we'll probably just go over those exams and all the answers on those exams, all 4 of them, so that you know, if there's anybody who needs to do makeup, I would encourage you to get exam 4 made up very quickly so that we can final exam on that Thursday, which is the last day of the class session. The course was really designed to take exams in class, and I think during COVID, we sort of rolled all the exams out to Brightspace. So I think that we probably made ourselves a little bit too much time for class time when we, I could have put more chapters in here, nobody is probably eager to do that. But I think that we anticipated that we'd be taking exams in class rather than online. But I think that during COVID, since everything was moving online, we sort of pushed that there, and it sort of has stayed there. And I think most people prefer that. However, if you do want to take it in class, and I know I said this very early on in the semester, if you do want to take an exam in class, just get with me, and I'll be more than happy to make you a paper copy and do that. I mean, everyone's different. Some people prefer paper exams, some people prefer paper textbooks as opposed to online. So I get it. So it's not a big deal. Got it. All right. So if anybody did not take the exam last week, let me know if you want to do a makeup of that. Again, you don't have to make it up. And if you want to just use that as the exam that you drop, because again, we dropped the lowest of the first 4 exams. The final exam can't be dropped just because it's a requirement that we have some sort of ending activity for the course. But if you do want to drop, or if you do want to just simply let that go to 0 and drop it, there's no harm, no foul if that's what you want to do. But let me know what it is you want to do if you do want to do that, so that I can make that available to you, because we've got sort of a tight window to take that. It's only a week. So I'll make that available to you. Okay. I'm trying to move the camera around here, and I'm not doing a very good job. So, okay. So that's the plan for where we are for this week. And what we're going to do is we're going to talk today a bit about money and monetary policy. And let's see here, moving the camera. I think this thing was set backwards, because every time I move it one way, it's going the other direction. So there we go. I think somebody must have flipped a switch on this remote here. So. Okay, or it could be operator here, whichever you chalk it up to be. So we got into last week talking about money, what it was, what monetary policy was about. and or what banking was about, because it's really an important topic for us to explore, because it really leads us into the areas of policy. Okay, and we're going to be talking about government policy now. I had mentioned before that in this this last segment of the class that was leading up to the third exam, I said that section was mostly about theory. So we got into Keynesian theory, we got into classical theory, we got into this whole notion of what economic theory was about. And I said, okay, once we get through that, we'll probably get more into some of the issues of policy. And that's a pretty critical point of really understanding macro, because I think when most people think of macroeconomics, they think about, okay, what is government doing to correct this problem or correct that problem? And so, and again, as I mentioned numerous times before, that whenever we use the term policy in this course, we're almost always talking about policy from the standpoint of government policy. Okay, so I want to revisit some of the material we talked about last time. I don't want to go spend a great deal of time on it, but I do want to talk about sometimes the best way for us to understand money is by explaining what it does as opposed to what it is. We can say what it is, and the definition that we gave was simply this. It was the idea of fiat money. It's basically just paper money, that our money is not backed by gold or silver or anything like that. So it's legal tender, and very disconcerting to a lot of people who I think still believe that money is backed by gold, and that somehow the gold sitting at Fort Knox is what backs our money supply. And that is not the case at all. We do have lots of gold sitting at Fort Knox, but it's there because it belongs to the government, or the U.S. government also collects rent by storing other people's gold, other countries, because overrun by anybody. And so it's a good place to put your gold. They simply park it with the U.S., but that doesn't back the money supply. It's just gold as gold. At one time it did, so we need to understand that the government just simply issues paper money, which is really not so much even paper anymore, since a lot of transactions and a lot of accounts are simply electronic based. And so let's hope these systems never go down, because there's very little paper money floating around in relation to what there used to be, because people don't really use cash as much anymore. In fact, people don't really write checks very much anymore. I mean, I know probably most of us have a checking account, and how many checks do you really write? I mean, it's rare that you go to a store, a grocery store, a drugstore, and stand behind the line in somebody who's writing a check. I mean, if they do, it's probably somebody who's maybe elderly, maybe on their years, and hasn't quite caught on with what a debit card is or whatever, doesn't know how to use it. It's a check. It's almost like, oh my gosh, this person's writing a check. You got to be kidding me. Going away. So really, this electronic means is really what it is, but really no different than issuing paper money in the first place. So when we talk about what it does, what it is, talking about what it does, these first two are the most critical ones: a medium of exchange and store of value. We talked about those before, and how they linked up and synced up with the two elements of the money supply. Let's go over those once again, and then I'll sort of move into another aspect of this. Okay, so again, the money supply is composed of two elements. And I want to make clear, I talked about this last week, just because I want to make sure that in case you come across some old information somewhere, older textbooks maybe, or websites that have old information, there was in the past a much broader sort of breakout of these components. There was M1, M2, M3, M4, and there was one even beyond that back in the day. And this is the Federal Reserve, our central bank, which has decided to simply say, okay, we're going to make it two elements because it really matches better the way that we think about money and what it does. And it's going to make even more sense once we get into money demand. So here we're talking about the supply of money, money supply. We'll talk about money demand here shortly, and how it also links back up with these first two uses of money: medium of exchange and store of value. Okay. So when we talked about the money supply, and what did we say about it? Lights up here. I'm going to need lights. And we said, okay, we know there's a medium of exchange, and what does that do? And what does that do for us? Okay. Well, actually, before I do that, let's talk about, and I know your text has got a very similar sort of graph, but if you take M2, and all of M2 is basically encapsulated all of M1. M1 is basically a subset of M2. So when we talk about M2, and we're talking about the interest-bearing portion of that, savings accounts, CDs. CDs are the big aspect. These are the time deposits that people put on deposit for however length of time, 3 months, a year, 10 years, whatever. And that's a big element of it. And those are interest-bearing form. We have to, when we talk about M2, we need to sort of say, okay, but not the M1 portion, because M1 belongs to a separate category, which is essentially this idea of the less liquid part, the non-interest-bearing part of the money supply. And that's where we get into this notion of not earning interest on this money. This is basically checking accounts. Checking accounts, cash, coin. We also talked about some things like money orders, traveler's checks as being elements of M1. And this tends to be very spendable money, usable money right away, okay? So we talked a bit about this before. So in other words, M2 is a cumulative measure. So, but why do we do this? What is the purpose of sort of breaking out this notion of the money supply? I mean, who cares? Why do we have to divide it? Isn't the money supply just the money supply? Let's just manage that. Well, maybe, maybe not. And we're gonna make the case that the answer is actually maybe not. So again, I want to kind of link back here to what we talked about before, where we said, okay, what are the uses of money? Uses of money here. And the first of these uses was as a medium of exchange. And again, we talked about this as being really our first acquaintance with money, you know, even from childhood. Then we got the supply of money here, and that links up with M1. Okay, it sort of syncs up with M1. And then also as a store of value, and that is the idea that we can simply save money as opposed to spend it. So the non-M2 portion, then this is the M2 portion that is not associated with M1. Okay, the non-M1 portion of M2. Okay. All right, so let me leave that there because we're going to get into the demand for money in a minute and talk about what that is all about. And then we talked a bit about the functions of banks, and we went through that last time. I won't get into that, and money creation and what that was about. And I want to go on here. Now I know I haven't posted this information yet for this week. Mostly, I wanted to sort of add to some of this discussion before I posted that. So I'll make this available sometime later today. So I just didn't have the opportunity to get to it. So we talked. The very last thing I think we talked about to wrap this section up was the idea of the money multiplier. And that was the idea of money creation works through the multiplier. Now, we've already talked about one multiplier in this class. It was the consumption multiplier. That was the reciprocal of the savings rate if we changed people's disposable income. And we needed to know that because it's a reciprocal, basically saying, okay, look, in spending, if it's 1 over the MPS, meaning that if we change people's disposable incomes, how much of that's going to get spent, how much of that's going to get saved. And so we said, okay, it's this, if we expand the money supply or if we expand demand for disposable income by $10 billion, the multiplier is 5, and we have a change in total aggregate demand of 50 billion. Well, the same is true here, but now this is mostly a monetary issue. If we expand the money supply, it is the reciprocal of the leakage, which is what savings is to consumption. And the same goes here. It is the leakage of what does not get loaned out or invested. We're going to talk more about what this triple R is here, probably, if not today, then certainly on Thursday. It stands for the required reserve ratio. And sometimes you'll see textbooks have it 1 over, and it'll be capital R, sometimes just for reserves. The triple R is what most people in the econ and financial world look at. And what it is basically just the reciprocal of what amount that is expanded through the money supply that does not get loaned or invested because it's required to be set aside as reserves. So it's required reserve ratio. It's basically just a percentage of deposits that banks can't loan and can't invest. And so because if that goes up, it means the banks have to set aside more of the reserves and they can't loan it, they can't invest it. So it doesn't work its way into the economy. Where does it go? It goes to the Federal Reserve, our central bank, which we're going to talk much more about here in just a second. And it goes there and it just sort of stays there and it sits on the bench. And up until a few years ago, the banks couldn't even earn interest on it. It just kind of sat there. And it was like money that's out of play in the economy. And if the Federal Reserve wanted to lower that rate, it could do that and they could free those reserves up to be back into the circulation by lending it and investing it. And we'll talk about the relative effectiveness of that particular tool, raising and lowering that reserve rate. And we'll get to that a bit later, probably more on Thursday than today. But it's a tool by which the Federal Reserve can control the money supply. Now, here's the thing about the reserve ratio. It started out not as being that at all. It started I mean, it's sort of made its way into becoming a tool of policy. And we're going to talk about that and the other tools that are at play. But initially, when it was first established in the 1860s, think about what was going on in the 1860s, Civil War in the United States. And so there was something called the National Bank Act that was passed, signed by President Lincoln, which basically standardized the way banks operate. So it created this concept of national banks. And so if you hear about the first national bank or the second national bank, the reason they're called national is because they're chartered based upon the criteria set by the National Bank Act. And that National Bank Act is still in force even to this day. And most of the banks that we see today don't have the term national in front of them, but it's usually sort of abbreviated somewhere at the end called NA, which stands for National Association. They have to for national somewhere in their name. So U.S. Bank. So if you drive down the streets of Albuquerque, you see U.S. Bank. There's no N, there's no national there, but it's probably U.S. Bank NA or Wells Fargo Bank NA or something like that. That's what you see. I know when I was in banking, customers would always ask what the heck NA means, and so you have to have the word national in there. So that's essentially what that is. So this multiplier is an expansionary tool that sort of means that as money moves around, it expands, because it's just like the concept of expanding consumption. As I spend money I didn't have before, I give it to a seller in exchange for goods. They've got to restock the inventory they didn't think they were going to sell. They go back to the wholesalers, who then order more inventory from the manufacturers. And all along the line, there are more people being paid, so it expands total spending throughout the economy. Same goes here. If I borrow money, I have new money that's being created. We talked about this last time. And it seems pretty incredible. I know the first time I was exposed to this as an undergraduate a long time ago, I thought, wait, this is how money is created through bank lending? That doesn't make sense. But in fact, that is true. It's not the only way, because as we'll see, the Federal Reserve, our central bank, does have a way to inject money into the system. But through the private market, this is the way that it is essentially done, through the process of bank lending. And conversely, as people repay loans, it destroys money. So money creation, money destruction, it goes on all day, every day. And so the question is, okay, well, because I know I addressed this last time, if bank loans are being made every day, why does the money supply just go on to this infinite level that it never stops, and we have more money than we know what to do with? It sounds like a good problem, although it really isn't. It's because people are repaying loans all the time. And by the way, when we get into this section of monetary policy, we'll see how the Federal Reserve can sort of tweak the money supply in order to raise it or lower it based upon what their objectives are. And right now, we're in a position in which the Federal Reserve is trying to rein in the money supply. There's too much inflation. Because remember, if you divide inflation as too much money chasing too few goods, money out there. And I know that sounds like a really harsh judgment to make on the government. Hey, the government's trying to take money out of our hands. That's exactly what they're trying to do, which is why we don't allow elected officials to do it, because it's just not something elected officials are really wired to do. We're going to take money out of play in the economy. We're going to take money away from you. Well, that's not something elected officials would want to say. So we created the Federal Reserve in 1913 to sort of match other nations' central banks, notably the Bank of England, which had been around for hundreds of years and had been relatively successful at. Oops, what did I just do? I just erased. I think I erased my whole file there. Let me start that over there. I just, whatever I hit there, that file went poof. So okay, there we go. So the Bank of England, I don't know what I just did. So there's one key I hit that made that thing. I hit the delete button. Bank of England was sort of the model for that, but now the Federal Reserve is the world's strongest central bank. And we'll talk about what that is. Before we do that, though, I want to take a bit of a segue, and that is, I want to sort of come back and circle back to our discussion about the money supply in relation to the uses of money. Okay, and I want to talk about money demand. And here, this is a bit of a strange thing to talk about, because I know past people have said to me, what do you mean money demand? Isn't the demand for infinite? Because we've sort of led people to water by saying, up until this point, one of the ways to understand consumer behavior and firm behavior is that they're engaging in maximizing behaviors. Remember, if we go back to the circular flow model, back in week 1 of the class, we said, okay, we have 3 actor groups in the economy. The 2 actors that constitute the private sector are households and firms. And what are they seeking to do? They're engaging in, we're saying all actors are engaging in maximizing behavior. Firms are out to maximize profit, and consumers are out to maximize their utility and consumption, which we didn't really talk about in this class because it's more of a micro topic, but we're talking about they're engaging in maximizing behavior. So if an economic actor is engaging in maximizing behavior, isn't their demand for money infinite? Because we've already said, okay, one way to understand economics is by talking about unlimited wants and scarce resources. In other words, the term unlimited sort of suggests that our demand for all these things is unlimited. However, that's not really true, because we're going to sort of temper our discussion here by talking about demand for money as money itself. Money as money, but not money as wealth, not money as any other thing. So we're not talking about money here. And I know that sometimes people say, well, you know, some actor or, you know, movie star or whatever athlete has got lots of money. Well, maybe they do have lots of money, but maybe they've got lots of wealth. That's really what we're talking about primarily, is lots of wealth, because there are a lot of people who've got lots and lots of wealth, but have very little money. It does happen. And in fact, this issue of running out of money is not all that uncommon, because you can easily tie up all your money in things like real estate and stocks. Stocks are pretty liquid. You can sell those fairly easily, or whatever, businesses. And so you may be cash poor. It's not unusual at all. And so when we talk about somebody being either cash rich or cash poor, we're talking about the fact that their demand for money is based upon the different uses of money. So the first use of money, the first demand for money is what we call transactions demand. This is money to be used for ordinary transactions, okay, hence the name. So what are we trying to do here with transactions demand? People are simply getting money in order to make ordinary payments and ordinary transactions, okay? So it's a pretty simple concept in that regard. All people are doing here are simply using money to make ordinary payments, okay? And that's pretty straightforward. And then asset demand, on the other hand, is a bit different, because then it's demand for money to be used as savings. So how does this then match up with our description of the uses of money, and maybe more importantly, for our purposes here, how does it match up with the money supply? And it does. So if we said that the most two important uses of money were as a medium of exchange and as a store of value, then we can talk about the demand for money as then being connected here. And that is, as a medium of exchange, our demand for money is for transactions. That is, we want money in our checking account, we want money in our pocket in order to make ordinary transactions. In other words, it's a medium of exchange. And it's not just simply I go to buy apples at Albertsons and such that. It's also I'm paying bills, I'm paying routine expenses. And what do you do with money that's used for routine expenses? Usually you put it in a checking account, right? Or you put it in cash. There are people who like to carry money around with them, and that's fine. And but all that is intended. You hold it in this form in order to create to satisfy this particular demand. So the supply is really to satisfy the demand. And that is, what am I doing with the money? I'm paying ordinary expenses. These are not unusual. Now, if let's say you want to go buy a car, you need to take $10,000 out of savings, you get cash. Well, that's not probably a routine transaction unless you're in the business of buying and selling cars, right? So that's not unusual at all. People take money out of some sort of savings type investment and move it to cash to make a down payment on a house, or buy a car, or buy something big, or whatever, those durable goods purchases and things like that. But for the most part, these are routine transactions. Hence, we simply call it. Likewise, when we talk about the store of value, we're talking about the non-M1 portion of M2 satisfying the asset demand. So these are sort of associated with one and the other. They're not equal to, I'm simply saying they're associated with. Okay, and so that's really the important thing that we're talking about here, is this idea that this money is used for particular purposes. And I think that's really the important thing that we need to understand. Now, why is this a big deal? And why, since we're leading into the policy section, why does the government care? In other words, our Federal Reserve. And I know we've talked a lot about the Federal Reserve intermittently in this class, and I've said before that it's almost impossible to do a macro class without talking about the Fed. I wish we would probably introduce them earlier in the semester so that we knew who they were, but they're our central bank. They're really in charge of managing the money supply and bank oversight, and we'll get into more of what they do. But back to the question, why do they care? They want to care if money is moving from here to here, because it means it's going to explain people's behavior. Demand is a little bit more difficult to kind of get your arms around. I mean, and one way demand is evidenced is by the actual data itself. M1 and M2 are easily visible. Money doesn't lie, in other words, right? And I guess money talks, that sort of thing. So if you know if money is moving from M2 to M1, people are getting ready to spend that, and it's going to be used to make purchases. On the other hand, if money is moving from M1 to M2, which it's really doing at the moment, then people are sort of withdrawing from making payments and putting more money into savings. Now, why are people doing that now? In fact, we saw the non-M1 portion of M2 really sort of be kind of depressed for a long time as money was sort of leaving the money supply and going into things like the stock market and whatnot. But now bank deposits are actually becoming pretty attractive investments. I mean, you can buy a CD that pays in the mid 4% range. And I think most people 10 years ago would have been very happy with a 4% return, 4.5% return in the stock market, despite the fact that they're risking their money in the stock market because they could go to zero if that company goes out of business. And by the way, there are a lot of companies that go out of business that we wouldn't think would go out of business. So I know when they talk about stock market as being a long-term investment, and I know we're not going to get into the stock market a lot here, but if you consider the fact that there were companies that were pretty good investments at one time, Sears no longer exists, right? Stock went to zero. General Motors, if you ever been West, General Motors is like its own empire. Their stock went to zero when that company went bankrupt. So there's a reason why people are moving to M2. You get a decent return with no risk to your money, and is FDIC insured, that is insured by a government deposit insurance agency. And the evidence from the last, 2 or 3 weeks now shows that the government is actually willing to step up their coverage of depositors, even over and above the limits, which are $250,000 per account relationship. By relationship, I mean titled in your name, maybe titled in the spouse's name, titled jointly, that's 3 times 250,000. But there are depositors at Silicon Valley Bank who have millions of dollars in deposits. And they were all essentially bailed out by the FDIC, our depository insurance agency. That was a very controversial thing to a lot of people because a lot of these firms were cryptocurrency firms and hedge funds. Hedge funds are basically investment pools that manage money for wealthy individuals and institutions. These are not places where you can open an account unless you are qualified. But they were bailed out, and a lot of people thought, well, why are we bailing out these very wealthy, risk-taking operations when they knew what they were doing when they put money on deposit? They knew they were over the FDIC limits, and that's a good argument. I mean, I don't know what the answer to that argument is, because I think it's a very good argument. Why are we bailing them out when they knew what they were doing? If you put more than $250,000 on deposit in any bank, even the most well-capitalized bank, you are taking a risk that you will not get that money back because you're not insured up to that limit. Which is why people who've got lots and lots of cash that they want to just put in the bank move money around. They go to different banks because they're insured separately at each bank. And there are people who just like putting money in the bank because it's there and you can always go get it. Even if it's M2 and you're locked into some sort of time relationship, you may pay a penalty, but you'll still get your money back. Where in the stock market, maybe you get it back, maybe you don't. Maybe it's a good investment, but it's gotten pounded by the market for all kinds of reasons. And I don't mean to run down the stock market. I am an investor in stocks, and I realize it's a long-term value proposition if you know what you're doing. But a lot of people do not, and so there's been a lot of money lost, unfortunately. But not very much money lost in bank deposits, M1 and M2. In fact, nothing has been lost in banks since I think the 1930s. I don't think anybody, even during the 2008 financial crisis, I don't think anybody has lost any money in deposits, even if they should have. And I put that in quotes because I'm not wishing for that for anybody, but even if they should have, because they on deposit, they want the FDIC limits to cover them for. So, but this is what's going on right now. We've got this movement to M2 because it's now becoming very attractive. Now, what does that mean though to the broader economy? It means that if you're taking money out of this, to move into this, it's basically taking money out of play. One of the things that we refer to in the financial world about M1 is it's known simply as hot money. Okay, hot money. Hot money is this idea that it's money ready to be spent and it's ready to move. And a lot of times people will move money to M1, even if they're not looking to buy something. But they're also looking to put money into investments and to buy real estate or to buy stocks or to buy whatever. And so it's very hot and it moves very quickly. And we're going to revisit this topic of what we call money velocity a bit later. Probably on Thursday, we'll get more into that and talk about what that looks like. Okay. So hot money is something the Federal Reserve is very interested in looking at because it does mean a lot in terms of understanding what's going on in the economy. So let's take a look at what the graphs of this look like. And the camera's moving slowly. There we go. All right. Okay, so let's talk about what this looks like when we talk about the money supply. Well, first of all, I want to come back. Remember we've been looking at graphs before where you've got some sort of vertical and horizontal axes, or something like that, right? You've got the price of money on one axis, or you get the price of whatever on one axis, and then on the vertical one, the quantity of that good on this axis here, right? Well, here we're talking about the quantity of what, the quantity of dollars, okay? And sometimes you might see this is just a dollar sign on the graph itself. And what is the price of money? Well, the price of money is the interest rate, okay? The interest rate. Now, before we go further, let's talk about the interest rate, because I know that sometimes this is an area that causes people a lot of consternation, a lot of confusion, because the question is, what do you mean by the interest rate? And I've said this before in the class, because I know that there is no one single interest rate out there, because people will say, okay, the interest rate is different for savings accounts, from credit cards, from mortgage rates, from student loan rates. How can you talk about? So whenever we're talking about the interest rate in the economy, usually if we're doing modeling, we will talk about a particular rate that's known as the Fed. Now, what is the Fed funds rate? It is a rate of lending. It's expressed as an annual percentage, and it's the amount that banks lend each other overnight. So that's really what we're measuring. Now, unless we specify something differently, because in order to justify, and we're going to talk about why the Fed funds rate is important. Whenever you hear on the news, the Federal Reserve raised interest rates, which is what they've been doing lately, it's the Fed funds rate they're raising, okay? And we'll talk about the importance of that. It's increasingly important as a tool of monetary policy, because it really means the Federal Reserve is either trying to make a change to the money supply for whatever particular reason, okay? So if we're talking about the interest rate, we're talking, and we need to key on one rate, it's usually that, because it's the very lowest rate that can exist probably anywhere in the economy, with maybe the exception of, maybe some very short-term treasury securities. Because I know that if you take finance, and some of you probably will, if you want a business going to take finance, you'll see something called the risk-free rate of interest. That's really a corporate finance term that really doesn't have much to do with this, but it's somewhat connected. It takes the very shortest maturity and the very safest interest rate, and that's usually on treasury sort of securities. It's a little bit different than this, but it's very, very similar. Okay, but let's talk about interest in general. Whatever the rate is, what is the interest rate? So let's talk about what the interest rate is. The interest rate in general is the rental cost of money. Okay, it sounds like a very wonky academic definition, I guess it is. So it's the rental cost of money expressed in annual percentage terms. Okay, in annual percentage terms. So every time you see an interest rate, it is an annual rate. Okay, this is not like The Sopranos, where they talk about lending money at 2%. That's 2% a week, and that would be like over 100% per year. This is basically interest rates that are charged on an annual basis. So if you take out money on a mortgage now, a 30-year mortgage, fixed rate is about 6.2, 6.3%. That's per year, not per month, not per day, or whatever. It's per year. So it's a rental cost of money. And so what's going on here? Well, with what rental, what do you mean by rental? Well, it means that money is usable and reusable. I can use it, and once I'm done with it, it goes to somebody else. And so as a result, I'm simply borrowing money to pay it back. I'm giving it back. And then the cost of that borrowing, the premium I pay, is the amount of interest, and that's simply the cost of money. And there's no way around it. I know that at various times in human history, there have been issues concerning the morality or even the religiosity of charging interest. And I know that at one point, lending money at interest was considered very sinful. Even in this country going back 200 years, the whole practice of lending money at interest was considered to be a little bit shady, a little bit, somebody's up to no good, right? If you're lending money at interest, you're profiteering. Even as recently as the 1930s, President Roosevelt, who was the president during the Depression, talked about bankers and called them money changers. That's kind of hard to hear when you, somebody like me who made a good living in banking, call them money changers. Where have you heard that term? It's a biblical term for people who are lending money in the temple and defiling religion. So I think we've mostly gotten over that now, but I'm making the point that for a very long time in this country, there was this idea held by some that any kind of transaction involving interest was, by definition, taking advantage of the other party. And as a result, it was considered to be disreputable behavior. Bankers themselves were considered disreputable characters for a very long time. And in fact, they earned that reputation in a lot of cases because early money was not backed by the government at all. It was issued by banks. And banks could just simply print out their own bank notes. Bank notes were money, and places, and nobody had ever heard of them. And you really had to question whether or not you were dealing with a reputable institution or not. And if you're lending and paid to you on your deposit, well, good luck with that, right? So, but we need to understand the interest. We've sort of gotten over these concerns, mostly because we've involved government in regulating this industry very, very heavily and very, very closely. And so almost every transaction that's involved in everywhere in the economy involves some connection to the financial system. And that's a good thing, because if we can control the financial system, we can sort of better organize the means by which we transact business in the country. And that's a good thing. And why it's a good thing is because the fact, not that the government is controlling things, but they're being able to regulate things. It would be like chaos on the field of football if we didn't have referees. So now we have government involved as the referee to make sure that there's fair dealing and that people aren't charging excessive rates of interest and all of that. So I think that the industry is mostly regulated. Okay, so general market for money. We're going to be building more on this a bit next time, but what does this mean for purposes of demand for money? Okay, well, let's talk about what that looks like then. So we have demand for money that, from a transactions demand standpoint, looks like this. In other words, it's completely vertical. And what does it mean when we talk about demand for money? That is, the equilibrium amount of money is whatever is being demanded. And remember, whenever we have on a graph in these two-dimensional graphs, whenever we have an expression, this is not really a function because it fails the vertical line test, meaning that you can have infinite number of interest rates and the same constant amount of quantity of money. It means that it's whatever it's parallel to, it's unaffected by. So transactions demand for money is unaffected by the interest. Why that would be, if you've got money in your pocket, are you going to say, hey, I've got too much cash in my pocket and I could be using it to earn interest somewhere? Maybe, but what is more important is, would you do this? Would you say, okay, I've got $500 in my checking account, pay my expenses for the rest of the month. Well, I'm not going to pay P&M right now. I'm going to put money into a savings account in order to grab a little bit of interest. In other words, I'm going to take my transactions demand and create asset demand. I'm not saying it's never done, but it's not really done. People don't really act that way. They simply park money in M1 type vehicles, checking accounts, credit union share draft accounts, cash, coin, whatever, because whatever the demand for money is whatever the demand for money is. And it doesn't matter what the interest rate is. You're not going to not buy groceries and not make your car insurance payment and not make your rent payment because you're trying to chase interest rates. It just doesn't work that way. And so as a result, transactions demand is unaffected by the interest rate. So if it's parallel, it doesn't matter what the interest rate is. It could be low, it could be high, it doesn't make any difference. Transactions demand is going to be whatever it is. Now, it can change over time, and presumably it will as the economy grows. As the economy grows, we have more demand for money to be used to be able to fund those transactions of consumption, investment, government spending, net exports, right? Those elements of demand. So obviously, this is the rocket fuel that sort of makes these whole things happen, the whole thing happen. But we have to make sure that we regulate money so that the money flow of the economy sort of matches up and syncs up with the physical flow. And there's a reason early on in the class why we went through the circular flow model, because what we're doing is we're saying, okay, there are really two economies. And this is where I think a lot of people do not understand this important fact about macroeconomics, but it's something that if you do want to understand macro, you really need to understand that there are two economies. There's the so-called real economy of goods and services and labor, like all of us. You're here, you're engaging in an activity. I'm doing my job, I'm being paid a wage. And I'm going to go to, I don't know, let's say I go to Starbucks and get a cup of coffee. That's the real economy. But there's this less obvious economy. It's money flowing around, people making deposits and borrowing money and banks lending it and the government injecting money into the system and all that. That's a little bit less obvious, that green arrow flow that compensates for the red arrows. But what's important is the fact that whenever there's a macro problem, it's usually some out of sync condition between those two economies, the money economy and the real economy. The real economy being where we tend to live on a daily basis. The money economy being all this money flow that's going on out there. And by the way, if you need any evidence of that fact, think about what happened 3 weeks ago when three of the banks in the US went down and Credit Suisse, a very large, this was a bigger shocker than the Silicon Valley Bank, to me at least, this is a really old, gigantic Swiss bank that went under. And we'll talk about why these banks are having trouble, but that's one example of the fact that money economy can bleed over into the real economy. And because if you've got problems there, you've got problems everywhere, which is why regulation is so critical. And we talk about this again and again. It's like having a football game with no referees. It doesn't really work that way, okay? You need to have referees on the field to control the money supply, okay? But this is one aspect of the demand for money. It's transactions demand. What is the other aspect? And let me just go and label this here so you've got this. This is transactions demand, okay? In other words, it's independent of the interest rate. It's independent of the interest rate. All right, what is the second component of demand? Then it's this. You've got the same horizontal axis here, which, well, same two axes really, supply of dollars and the interest rate, okay? And yet, what does asset demand looks like? It looks like this. Well, and you might think, okay, well, it's downward sloping. And what do you expect the demand curve to look like but downward sloping? But it's a little bit counterintuitive, okay? And let me explain why. Because, okay, asset demand is associated then with earning interest on the money, at least the non-M1 portion, okay? So why would we want to have more money as the interest rate falls? What is going on there? Wouldn't it be the other way around? Wouldn't we want to demand more money as the interest rate goes up as opposed to falls? And the answer is no. And that is because of this. But it sounds like, okay, well, there's just an inverse relationship between price and quantity, which is really what this is, price, quantity. And let's say we've got some Q1 here. Let's say the rate falls to 3%. And we demand more of this. Well, then why would we do that? Why would we want to demand more money when the interest rate falls as opposed to winning? And the issue has to do with money as money, okay? This is money as money. This is asset demand for money. We're holding money as an asset. Why would we want to hold more money when the interest rate falls and less money as the interest rate rises? Because it expresses the opportunity cost of holding money. The cost of holding money goes down when interest rates are low because you're not giving up the opportunity to get. Remember, opportunity cost means it implies there's some opportunity somewhere that you can get. And that is, what can you get? You can get more money somewhere else if the interest rate is higher, like the bond market. We're going to talk about bonds specifically today because it's got an important relationship to economics and to monetary policy. So if in fact the interest rate goes down, we'll hold more cash. Why? Because it reflects the opportunity cost of holding money. Okay? It reflects the opportunity cost of holding money. So if the interest rate goes up, and I'm going to sort of clarify holding money as money, because I know a lot of times people get confused when we hear money, we think about all wealth and all assets. And that's not really true. This is money as an asset as opposed to some other good as an asset. In this case, it's going to be bonds. We're going to talk about that. And that is this, if interest rates in general are falling, and remember, we're talking about the Fed funds rate as being a driver of all interest rates, and they are. The Federal Reserve has been raising that Fed funds rate aggressively, about 4.75% over the last year, really, year and a half, year plus. And so that's driving up interest rates throughout the economy. Well, if interest rates are going up, then we just simply reverse this whole transaction. And so Q2 is now Q1. And now we're going the other direction. We're saying, okay, now I want to hold less money and I want to hold bonds now. So I'll hold less money and hold more bonds because I can get a better yield on bonds. But if bond yields are coming down, I might as well just hold cash because I'm not earning anything on bonds. And one of the things about bonds, and for anybody who's not familiar with it, I think this is one of the reasons why there was so much press attention to these bank failures, is because a lot of people were not realizing how risky bonds can be. Because I think what a lot of us think about bonds as being pretty simple financial instruments, but they're risky because they can fluctuate with interest rates. So if the rates are falling very, very low on bonds, why hold them? Why not just hold money? You're not going to get much of a return, but you're not getting much in return on bonds. And you're taking the risk that those bonds will lose value if rates do go up. And this is exactly what we saw happen with Silicon Valley Bank. And I think it's a very timely thing that happened because it really explains a lot about how we can understand these financial dynamics. Because I think, and to me, when it's really, it's kind of a shocking thing, but it's something that as economists we're used to, and that is when you hear that on the press just really has no idea what's going on. Why this bank failed? Oh, is it sign up for something else that's going on? Are other banks going to go down? Is the sky? Is the world ending? I mean, this is really some of the sort of apocalyptic, and maybe it is, maybe it's not. I don't think it is. I think these bank failures were due to the unique mismanagement of those banks that were not counting on interest rates going up, and they just simply didn't expect that to happen. So, and we'll talk about those dynamics as to what that's going on. So, anyway, this looks like it's counterintuitive, but I think the only way to understand asset demand, remember, it's demand for money as money, is to understand that there's an opportunity cost of holding money as money, and that is the opportunity to earn what? Well, where's the opportunity? The opportunity to earn bonds and earn a higher yield. If you get a higher yield, you might take the extra risk that goes along with holding bonds. Okay. All right. So think about this then. I guess I raised this, but the M2 portion is a lot bigger than M1. M2 reflecting the evidence of asset demand, M1, the evidence of transactions demand. So if we're to add both these together, remember, these are mathematical expressions. Whatever the quantity of dollars is whatever it is. At any given time, we can simply take a picture of that. Whatever the demand for money is whatever it is. And so if we add both of these up, then we get the money supply or the money demand, all demand for money. And so if we put the quantity of money on the horizontal axis, the price of money on the vertical axis, then what do we end up with? Well, there's a lot more asset demand than there is transactions demand. And so as a result, the money demand curve basically takes more of the form of the asset demand. And so money demand overall is downward sloping, reflecting the inverse relationship between the interest rate and the quantity of money being held. Okay. And let me see, I don't know if I can get a camera to swivel over there a little bit. There we go. So I think that captures that pretty well there. So transactions demand plus asset demand equals, so should an equal sign here, equals the demand for money, which is downward sloping. Okay. All right. So questions about that. All right. One final thing before I sort of move on to sort of elaborate a bit on this, because if this wasn't completely obvious, I want to come back to it and talk about why, about what some of these dynamics are, and it should help explain some things. But one thing I want to do is this. I want to introduce one other topic, and that is this. The money supply, whatever it is, money supply is composed of M1 and M2, okay? So the supply of money is composed of these two elements, M1 and M2 together. And so we say the supply of money is basically looks like that, because however much money there is in the economy at any given time is however much money there is, okay? So it's a relatively fixed rate. Now, it's going to change. It's going to go up. It's going to go down, up, down. It's going to fluctuate. It's going to have a lot to do with what's going on in the economy and with monetary policy. And so as a result, we say that we have an equilibrium interest rate, which, by the way, is oftentimes associated with the Fed funds rate, okay? And so we'll say right now the Fed funds rate is, it's usually in a range of 0.25%. We usually take the top end and say it's 5%. And that's the equilibrium interest rate in the economy. from there, all rates sort of go up because we know that most people don't borrow at very low rates. There's usually some markup over those rates because this is the rate that banks have to pay other banks to borrow money. So they're in the business of just like buying green beans at 20 cents a can, selling them for 50 cents a can. Same idea of markup. Maybe not that large percentage, but banks are going to mark those up. This is why interest rates fluctuate all of the economies, because rates sort of start at some level and move up. Now, the 5% Fed funds rate is the highest it's been in well over 20 years. In fact, I can't even think about the last time it's been about 5% or higher. And it's probably going to go up a little bit more. I don't think it's going to go too much higher because I think that the government has done what it needs to do, at least in the short run. But we will see. And as the Federal Reserve itself says, that these are all determined by the actual data. And so they won't know what's going on until the data comes in. Okay. Because I know everyone's trying to game the Federal Reserve and what they're going to do, particularly people in the stock market, and they're trying to figure, hey, what's the Fed doing? Sometimes trying to sort of talk them down and try to convince them that they're the error of their ways. We've heard this for a very long time. People in the financial world trying to convince the government that they're doing too little or too much or whatever. So these are not new things. Okay. All right. So I want to talk about one thing here before, and this will be the last topic we get into today, and that is this. If we said that demand for money, and notably this asset demand, which is composed primarily of the M2 portion, asset is very much influenced by interest rates, then, and because of the fact that it's downward sloping, reflecting the opportunity cost of holding money, and the fact of the matter is, there's a greater opportunity cost when interest rates are high, a lesser opportunity cost when interest rates are low. And so as a result, people are willing to hold more money when rates are low. Well, the opportunity is to do what? Hold money or hold bonds. And I want to talk about the bond market a little bit. And I think it's important for us to go over that and understand what that is, because I know that, and this sort of is a intersection here of econ and finance, and I understand that. So, but there are a lot of academic disciplines that have intersection points, history and sociology and political science and economics and whatnot. So we're sort of intersecting here with finance a little bit. But this is important because it's going to directly tie in to where we're going to go on Thursday when we talk about monetary policy, and that is the bond market. Let's talk about what bonds are, first of all. We've all heard of bonds. We've heard people talk about stocks and bonds, and we've heard about the bond market. And some of you may be familiar with bonds from an early age because maybe you've got a relative who might give you a savings bond for your birthday or Christmas or whatnot. I don't know how common that is, but a lot of people have savings bonds. All a bond is, everywhere is a market, is a long-term IOU that pays interest. That's all it is. Okay. But they typically are not issued by individuals. They're typically issued by some institutional issuer / borrower. Okay. It's a government, it's a corporation, it's a school board, it's a school district, it's a county, it's a municipality. There are all kinds of different bond issues out there. There are bonds issued internationally. Governments issue their own bonds, and certainly our government is a very, very big issuer of bonds because it's one of the ways we finance our deficit is we issue bonds. Remember, our government spends more on an annual basis than what it takes in. So how do you engage in that sort of governmental dis-savings? Well, just like anybody that spends more than what they take in, typically borrowing. So borrowings are simply, if you're talking about institutional borrowers, big companies and governments do not go to the bank. They don't walk up to Wells Fargo and say, I want to borrow money, right? They don't do that. Even large corporations don't go to banks to borrow money typically. If they do, it's for very short-term purposes, like to make payroll or to finance international transactions. Something is very specific. If they want to issue debt, they simply go to an investment banker and say, I need to issue debt. In other words, borrow money. It's the same thing. Issuing debt is the same as borrowing money. $500 million or whatever. These are large issuances, and the is to simply get the money together and say, okay, here it is. Here's the money you borrowed, and you will repay that over time. And so this is why these are long-term interest bearing. By the way, I know that when we talk about our Treasury Department, our Treasury Department basically tries to manage the books for the U.S. government, and because we spend more than what we take in, they issue on a routine basis new debt all the time. And sometimes they're very short-term in nature, like 90 days. And we simply call those bills, not bonds, because they're very short-term debt obligations. T-bills, Treasury bills is what they are. They run from, let's say, 90 days up to a year. I think it's 5 years. They're called notes. Those are really more like very short-term obligations. But anything over that is a bond, and it trades in the bond market. Bond maturities could be 30 years. There are some bonds out there that go for 50 years. That is, they pay routine interest, but the principal is not paid back for 50 years. And there are some bonds that never have any maturity at all. They just go on forever. And one example of that is a bunch of bonds that the British government has out there. They've been around now for, I guess, 200 years, because they were bonds that were used to finance the wars against Napoleon 200 years ago. And the British government simply decided to take all that debt, all that borrowed money from all over everywhere in order to finance the war, because the war was very expensive. And then they sort of consolidated them and said, okay, when are we going to pay it back? We don't know, maybe never. And there's no maturity date. They have no fixed maturity at all. They just pay interest in perpetuity. And they're called console bonds because they represent consolidations of all that debt. There's no maturity on it. All you do is you buy them and you just get a lifetime stream of income. And you get a lifetime stream of income to the point where, one of the good things about this is whatever the cost of that was has been incurred many generations ago. And so the British government continues to pay on these and really has no intention of ever paying it off. So they're still paying for the war against Napoleon. But guess what? We're doing something similar, because all the debt that we've got out there has been around for a very long time. We're still paying for World War II. We're still paying for the Apollo space program to land on the moon. We're still paying for a lot of debt that was issued years and years ago. I think we're still paying for debt that we issued during World War I. I mean, sometimes these debts go on and on. But think about this. Remember, we go back to chapter 9 and talked about one of the effects of inflation was it's better to be a borrower than a saver, because you're paying back in cheaper dollars over time. So if you consider the fact that the cost of World War II at the time was astronomical, it was about 25% of our current GDP that was being spent on the war effort. That's astronomical as a percentage. But in today's dollars, it's not really that expensive. We spent more on COVID relief than we did on World War II, but not as a percentage of our economy. It's just, so as a result, the cost of financing World War II today is not nearly as much as it was then, because the economy has grown, the money supply has grown, and prices have changed, okay? So this is one reason why people are paid a rate of interest, to compensate them for inflation, okay? So when we talk about the bond market, and by the way, I want to sort of contrast this a little bit with the stock market, because I know that a lot of times you hear the term stocks and bonds as if they were one thing, and they're really different markets altogether. And I know that in the past we've had people do our end of course. I thought I was going to hear more about the stock market in this class, and that's not really what we do in econ. It's more of a finance course type of thing. And so we do talk about the bond market because it's got direct importance to monetary policy, which is where we're moving. So for our purposes, it's much more important of a market. It's a much bigger market than the stock market. It's much older. Bonds have been around for a very long time. Stocks can come and go. Companies are buying each other, retiring stocks. They buy back their stock. They retire classes of stock. But bonds have been around for a long time. There's a giant market between them. And so we need to talk about one important relationship. And if you've ever had a finance course before, or even maybe an accounting course, you've heard about this inverse relationship between bond prices, which we'll call P sub B, and the interest rates, which we'll call I sub C. The C stands for something called coupon. So what is a coupon? Well, it's kind of an old school term that represents an annual payment of interest to a bond holder, that is a lender. Let's be clear about what the transaction is. If you're a borrower and you want to borrow money in the bond market, you just issue through your investment bank a large quantity of bonds, okay? That might mature in 30 years or 20 years or whatever, but you'll pay regular to the holders of those bonds, who are the lenders. And so if you own a bond, you're essentially a lender to an issuer who is a borrower. So it's a debt obligation. It's an IOU. These coupons, I say it's an old school term because in the past you used to have a bond that would have little coupons attached, and you would flip those coupons, little tiny coupons, like that. And you would flip them and you would give them to your bank. Your bank would go out, send them off to whoever was redeeming those. They would basically credit your bank account whenever they collected it. And so coupon payments, they actually were physical coupons. And so even back when I started banking, you would have people, mostly retired people who had lots of bonds, would spend a good afternoon sitting in a safe deposit box, coupon booth, clipping coupons. and coming out with a big stack of coupons. Okay, I want to turn these in, collecting interest on them. And that's, and we used to be a term called coupon clippers. That was people who would just literally clip the coupons. Well, today it's mostly electronic. We don't, in fact, you don't even have the bond itself. Your broker holds it, but doesn't actually hold it. It's just simply by itself, it's collected by your broker, and they'll credit your account, and you'll simply collect it. You don't have to do any of that. That's a good thing. But we still call it coupon because it's the annual payment in dollar terms. Okay. So dollars over price represents yield. And we simply call this is not the same as Fed funds rate. So that's why I put a little C there, because it represents the return on the bond in terms of dollars. Okay. All right. So let's talk about some of these relationships here. And I know this at times seems like it's a little bit off topic. Why are we talking about the bond market? Why are we doing this? Why are we talking about bond yields? Well, there's a reason, and it's going to have a lot to do with where we're going to go on Thursday. And that is, we're going to talk about how the government intervenes in the bond market directly in order to influence monetary conditions throughout the economy. Okay. So let's do this. Let's talk a bit about bond rates and what happens with bond prices. This is, by the way, also going to explain a lot about why Silicon Valley Bank in particular went down. And I haven't really studied the situation with First Republic Bank and what was going on there, but in both cases, both of those banks are going to be made whole by the government. Shareholders, their investment's going to go to zero, but all the depositors are going to be paid off. And they've found banks to cash them out, to bail them out, basically. So the government bailout is only temporary. It's not, it's not really what people think it is. But this explanation is going to explain why these things happen. So let's take a look at, so again, we talked about this idea of what's this relationship where we got some kind of coupon payment divided by the price of the bond. Okay. These are both expressed in dollar terms. Okay. So as a result, you're going to end up with some percentage. Okay. So when we talk about the coupon payment, what is it important for us to know about that coupon payment? Okay. The coupon payment is basically it's a percentage of what we call the face value of the bond. Okay. It's the percentage of the face value. Okay. So, and divided by the price of the bond is going to give us then some sort of annual return that we call the yield. So I sub C is what we call the yield. It's the return on an annual basis to the owner of the bond. Remember, it's expressed in annual terms. And so it's an interest rate, but it's more importantly, it's a yield, because it can differ from this, because why is this not the interest rate? Well, it is, but it's fixed. This is the thing to know. Now, there are variable rate bonds out there, but they're not as common as what you might expect, really. In fact, the Treasury has issued some, but they're not all that popular in some ways. And so for the most part, these are fixed at some percentage of face value. Okay, so we're going to say these are fixed. And that's one of the assumptions here. So let's say that we have some example here. Okay. Let's do a couple examples and we'll see what happens with these sorts of dynamics. And so let's say that we've got a coupon yield, right? That starts out at we'll simply call a 6% bond. Okay. So one example is a 6% bond, meaning that it pays 6% over the face value. Now, by the way, what is face value? Face value is typically $1,000, right? It's typically $1,000. That's usually the amount. But bond prices fluctuate. One of the reasons they fluctuate is because of this dynamic I'm going to talk about here. Okay. In other words, what do we got going on here? Well, paying 6% times 0.06, or let's say 1,000 times 0.06 equals what? $60, right? It's 6. So we have 60 divided by 1,000 equals 0.06. All we're doing is reversing this. As you're going to multiply it by 100 to get rid of the decimal sign and make it a percentage, you can do that. So it's now 6%. Okay. If you want to do that. But I kind of encourage people to get comfortable with the idea of percentages as decimals, because it better matches the calculators and computers. Now, it looks like all I've done here is simply play around with the numbers, and I sort of have, really, right? So if a bond is issued and the investment bank that issues it tries to get this coupon payment to be about what the current rate environment should be at the time it's issued. Sometimes they won't even issue the bond until they do what's called repricing, so they can get a better understanding of what's going on, particularly if rates are fluctuating. So if the current market rate for a bond of that particular safety and maturity is paying 6%, then that bond on $1,000 will pay $60. So if you buy 10 of those bonds, you get $600 a year as a coupon payment. They typically pay not annual, but semi-annually, but just divided by 2 and you get that amount, okay? All right, so that's a 6% bond. Now, think about this. What if, in fact, rates go up in the economy, right? Now, what happens if rates go up in the economy? And so, as a result, let's say that rates are going up and the 6% bond is no longer very attractive, okay? It's no longer attractive because why? Because now, and this is what's going on at the moment. If, in fact, when you bought the bond, 6% was a pretty good yield, but now rates are going at 8%. So the only way that it can encourage somebody to buy that would be to pay a discount. Fixed amount of $60. And so as a result, what happens is your yield actually pops up to compensate you because of the fact that you bought this at a discount. And if you simply want to move the decimal 2 points to the right, you now have a yield of 6.38%, which approximates the current yield that you can get from new investments. So again, the thing to know about is this: there's an inverse relationship between the price of the bond and the current yield that it can get. Again, why would somebody pay a discount for a present bond? It's because new bonds have a higher interest rate. Why do I want that old bond? The only way you're going to entice me to buy this bond that pays this low rate of interest is if I get it at a discount. Now, this is exactly what's going on with Silicon Valley Bank, because they bought lots of bonds at a very long time ago, and they had very low rates because we know interest rates throughout the economy were very, very low for a long time. What has happened is rates have gone up. And so as a result, those bonds have lost value. And so when people started making a demand for their money, they had to start selling those bonds, selling them at a loss. Why? Because they've lost value. They actually lost money holding bonds. It is possible to lose money holding bonds, even though it sounds like bonds are a little bit less risky than stocks, but they are in fact risky. This is what happened. They owned too many of these. And it probably would have been okay had there not been a bank run, but a lot of these people, that it was a very small bank in terms of number of depositors. A lot of them were Silicon Valley operations. A lot of people knew each other. It was described as a Twitter-inspired bank run. And that is, people all were on Twitter saying, get your money out of Silicon Valley Bank. Well, it's good. And because a lot of these people knew they were well over the insurance limits. And as a result, and by the way, the warning sign for this came sometime last quarter when they reported earnings, because they already had to meet redemptions. And as they moved money to a place in which they have to meet withdrawal requests, they incur the losses. And so they started to incur big losses. That's what started the bank run. So everybody wanted their money out, particularly those who were not insured because they were way over the $250,000 limit. And as a result, they demanded more money. And so they had to sell more bonds. If you sell more of anything, what happens to the price of that something? It falls. That something is less scarce. And so as a result, it fed on itself. This is really what happened with Silicon Valley Bank. It was basically mismanagement of their bond portfolio. They should have gone with much smaller yields. They were greedy. They went far out and got bigger yields, but it didn't pay off for them because they didn't expect to have all these withdrawal requests. And as a result, they had to sell these bonds at a loss, and the bank was losing money, and it would have failed. But by the way, any bank would fail if people want their money out. But you have a double whammy. The bank was losing money because the bond investments, they should have gone with something much shorter, much more liquid. They wouldn't have lost as much money. They wouldn't have made as much money in years past while they were owning those. But instead, they wanted to go further out and get longer maturity bonds at a higher rate, because the longer bond is out to maturity, typically the higher rate of interest that you can earn on it. Okay. And that's a bit of a problem. Okay. So this is what happened. So anyway, this is the inverse relationship. So anyway, if rates in general are rising, which they have been, current bonds go down in value. And so as a result, because this is a way to compensate new owners, whoever now buys those bonds has to be compensated for the fact that it's a lower yield. Okay. Now, what about the fact that what if rates go up in the economy? So now that 6% bond looks pretty darn good, right? So now people will pay more for it. Now let's say they will pay $10.80 for it, as opposed to that, because now current bonds that are being issued are paying 4% and 5%, not 6%. Well, you're still going to earn the same $60, but you're going to pay a premium for it. As a result, you're going to have a reduction in your yield your yield is going to go down to 556.556, I believe, which multiplied by 100 gives you a rate of 5.56. Simply because of the fact that now people, that 6% looks pretty good, but you have to pay more for it. That yield better approximates what the current yields are in the entire economy. And again, there's a lot more to the bond market than what I'm giving you here. I know that these rates are determined by investment banks who use ratings agencies to determine the solvency of the issuers. Part of the subprime problem came from the fact that these bond ratings agencies were saying these mortgage-backed securities were all sound, AAA, and they weren't. And that was the sort of the untold story of the financial crisis, was the fact that ratings agencies were saying these things are very stable and should have a very low rate of interest. But in fact, they should have, because they were much more risky. Risk and return go hand in hand. That is, and we define risk in economics as the uncertainty of an outcome. Now, the government borrows money at very low rates of return, very low rates, because there's not much uncertainty. The government is never going to not pay their bonds, because if they had to, they could simply just issue new money. They've got the printing presses, they can do it, but they're not even printing presses. As we'll see when we talk on Thursday, that the government can simply create money out of thin air. And I know that that's one way to do it. So because they can do that, the government doesn't pay much in terms of bond yields. And so those are very low rates of return to investors, but it's also very safe. It's also very safe. Now, Silicon Valley Bank wanted to go beyond that. They wanted to buy other sorts of securities that were a little bit riskier. Not the principal, but the rate of return they were getting, because bond prices fluctuate. This is the thing that we ought to know. Bond prices fluctuate. They have a direct relationship to interest rates. And this is the problem they had. They lost money as a result of this. Okay, so what's the relationship? What's the takeaway that we can say here? That is, if interest rates are rising, bond prices tend to fall. And if interest rates are falling, bond prices tend to rise. So this looks like what? It looks like the log. My lights here. And it looks like the log band, doesn't it? It's the log band because we're talking about the band. Oh, how it came off. That's weird. I guess maybe by moving around did that. Maybe I should just keep moving, right? So, well, where have you seen something? If one thing goes up, the other thing goes down. One thing goes down, the other thing goes up. It's an inverse relationship, and that's what's going on here. So on the slide that I put, so there's an inverse relationship between bond prices and current interest rates, or more importantly, yields. Yields are not the same as interest rates because they're simply the return of both principal and interest. And in this case, if you're buying at a discount, you're getting some of this back. It's still going to redeem it at $1,000. So you're getting part of your principal. And that's all considered interest return, by the way. But it's the fact that it's more than 60 over time. It's more than 6%. It's actually 6.38 because you're getting some of that back over time in a very long time period. Okay, depending on how long it takes to mature. So, okay, so that was a brief introduction to the bond market. Now, why do we do this? Because it's going to make a lot of difference when we talk about monetary policy on Thursday. Because one of the key tools of controlling the money supply, which is again a form of the government acting as a referee, is to work through the bond market. Because the Federal Reserve, our central bank, knows about these dynamics very much aware of it. So when they intervene in the bond market, they're trying to do things like influence monetary conditions and credit conditions, because monetary policy has two things. It's the government control of the supply of money and the availability of credit. And one of the ways that credit is either available or not available is through the interest rate mechanism. So it's those two things. And we'll talk about monetary policy on Thursday. So are there questions for me about anything that we talked about today with regard to money demand, bonds? One thing kind of leads to another. This is a natural, the bond money demand issue was a natural segue to this. This is also a natural and perfect transition into where we're going to go on Thursday. So, okay, well, if you do have questions, in the meantime, get with me. I'll post these slides sometime probably later today. I just need to, I wanted to make some changes. This is a different schedule on the last semester. So I'll put those up there. I'll also post the video, and we'll be all current. Okay. See you next time.